Everyone keeps saying the housing market is about to crash, but prices just hit new highs, and sellers still aren't showing up. So what's going on? Why hasn't the bubble popped? And what if everything you've been told about a 2025 housing collapse is flat out wrong? In this video, I'll show you why a crash hasn't happened yet, what could finally break this market, and what smart investors are doing while the rest of the crowd keeps waiting. Hey, I'm Robert, and this is The Alternative Investor. If you've been sitting on the sidelines waiting for a real estate crash so you can buy in, this video is for you. Let's start with the obvious. Inventory is historically low. The U.S. housing market is short by millions of homes, according to Freddie Mac, and that shortage didn't magically disappear post-pandemic. Builders slowed down after the 2008 crash and still haven't fully recovered. On top of that, current homeowners don't want to sell, because they're locked into 2 to 3% mortgage rates and refuse to trade up into a 7% loan. That means less inventory, fewer listings, and constant pressure on prices, especially in growing metro areas. In 2008, the crash was driven by subprime loans, over-leveraged buyers, and adjustable-rate mortgages. Today's market is very different. Roughly 85% of homeowners have fixed-rate mortgages under 5%, and household debt service ratios are near historic lows. Most homeowners have record equity in their properties and aren't being forced to sell. There's no wave of foreclosures coming, because defaults are low and delinquencies are well contained. Sure, affordability is down and many first-time buyers are getting priced out, but demand hasn't disappeared, it's just shifted. Millennials are now in peak home buying age. Gen Z is entering the market, and investors, especially institutional buyers, are still scooping up inventory in select markets. People still need homes, and unless unemployment spikes or rates surge even higher, demand will continue to outpace available supply. The Fed's rate hikes have cooled the frenzy, but they haven't crashed the market. Higher mortgage rates have frozen both sides of the transaction. Sellers aren't listing, buyers can't afford as much, so volume is down, but prices haven't collapsed. Unless we see rate cuts combined with major inventory increases, don't expect a huge price correction. Ironically, a rate cut might actually boost prices by reigniting demand before supply catches up. That said, the housing market isn't invincible, and there are real risks that could break the current balance. First, a massive spike in unemployment could force many homeowners to sell, especially those who recently purchased at higher interest rates and have limited equity. Second, a wave of forced selling, triggered by layoffs, rising mortgage payments for adjustable-rate loans or investor liquidations, could suddenly flood the market with inventory. Third, a black swan event like a major geopolitical conflict, natural disaster, or a financial system failure could shock consumer confidence and dry up buyer demand. And finally, a sharp increase in mortgage rates, whether from Fed missteps or panic in the bond market, could fully price out remaining buyers and send prices lower quickly. Until one or more of these catalysts materialize, the housing market will likely stay supported by tight supply and stable homeowners. So what can you do in this kind of market? If you're looking to buy your first property or expand your portfolio, focus on cash flow over appreciation. Don't buy based on hopes of quick price gains. Make sure the numbers work day one. If you're currently priced out of the market, this is the time to get prepared. Build your credit, grow your savings, and track your local inventory so you can act quickly when opportunity knocks. If you're a homeowner considering selling, you may still be in a window of strength, especially if you're in a low inventory zip code with bidding wars still happening. If you're a real estate investor, this is the moment to be disciplined and data-driven. Analyze cap rates, be cautious about leverage, and don't chase speculative flips in overheated markets. And above all, watch the big three: unemployment, interest rates, and inventory. Those are the signals that will tell you when this market starts to shift. So, will the housing market crash? Maybe someday, but not yet. Strong homeowners, tight inventory, and rate-locked sellers are keeping the system steady, for now. I'm Robert, and this is The Alternative Investor. If this gave you clarity, hit like, subscribe, and let me know in the comments, are you waiting for a crash, or do you think this is the new normal?